Hello and a warm welcome to the Open Treasury podcast, your go-to source for the latest news and analysis in corporate cash and treasury management. This show is brought to you by ctmfile.com and the Treasury News Network, where treasury professionals learn and share the information that matters most. I am your host Pushpendra Mehta. Joining me today is Dean M. Leavitt, founder and CEO of Boost Payment Solutions, an organization widely recognized as the global leader in B2B payments. A very warm welcome to you, Dean.
Push, nice to see you. Thank you.
We truly appreciate your time and insights as we explore critical topics shaping the landscape of payments and treasury management. In today's edition of the Open Treasury podcast, we shall discuss four topics, namely cross-border, real-time and digital payments poised to shape the future of payments, the dramatic rise of account-to-account or A2A payments, 4 ways to strategically manage cash flow, and finally combating payments fraud, key insights every treasurer and CFO must know. Our audience can watch videos on the CTM File YouTube channel and explore insightful articles, interviews, and industry roundups on ctmfile.com, either by visiting the website or by following the links provided in our show notes. Let's commence today's discussion with the first story, which is about cross-border, real-time, and digital payments poised to shape the future of payments. Payments, as we know, lies at the heart of global commerce and its digital economy. Payments are also increasingly central to corporate finance and treasury activities, facilitating the efficient transfer of funds both domestically and across borders. With payments serving as the backbone of our economies, 3 pivotal areas are expected to significantly influence the future of global payments. These are cross-border payments, real-time payments, and digital payments. Cross-border payments, that includes global trade, remittances, foreign investments, e-commerce purchases, and global workforce payments are set to enter a new era as organizations globally are laying the foundation for instant, frictionless, and interoperable international transactions. The push to streamline payment processes, the emergence of innovative payment methods, the rapid development of payment technologies, and the focus on enhancing digital security are among the most important factors driving a notable increase in digital payments. The evolving landscape of global payments is also pivoting towards real-time payments or RTPs, spurred by advanced use cases for consumers and businesses, steering global RTP volumes to record highs with 266.2 billion RTP transactions recorded globally in 2023, a year-over-year growth of 42.2% as per the 2024 Prime Time for Real-Time report published by ACI Worldwide. Dean, I have 2 questions for you. First, how do you envision the future of cross-border payments, digital payments, and real-time payments? And my second question focuses more specifically on cross-border payments, where I'd like if you tell us more about Boost's cross-border payment solution and how it simplifies and streamlines international transactions for corporate buyers.
Sure. 2 good questions that are obviously top of mind for many treasurers and various players across international commerce. Cross-border payments are very complicated, and in many current forms, they're very expensive, they're inefficient, and they pose problems for trading partners. Add to the mix complications regarding the data exchange among the trading partners. Many of these transactions are large and encompass large numbers of invoices. So as we look at cross-border transactions, first of all, Boost lives in an entirely digitized universe. So all of our transactions are digital, as is the way in which we report to the trading partners. When we talk about the need for interoperability, I think it's important to note that there is a difference between interoperability and standardization, right? I think we are a very long way away from standardization. So the market requires intermediaries to kind of sit in the middle of the trading partners and facilitate these payments so that there is a smooth transfer of funds through whatever rails are being used, but equally important, a smooth transfer of the data. that is associated with these transactions. And depending on the vertical, the industries, some are more complex than others. Some payments within those industries are more complex than others. So I think while most people, treasurers and others in finance and on either end of a transaction, focus on the movement of money, you're seeing an increased focus on the data that's associated with those transactions, with those money movements. And it's imperative that treasurers and others, finance directors, AP, AR, are making sure they're utilizing tools that can transfer the data aligned with these transactions in ways that they can be easily ingested on both sides, thereby reducing the cost. You know, when we think again of the cost of cross-border transactions, it can be a very expensive transaction because of all the moving parts, but add to the mix the human resource effort on either side of that equation, which is kind of obviously an indirect cost to the transaction, but one that is not necessarily focused on all the time. So to the extent you can migrate what are now very manual payments over to an automated process, the savings also are realized through that process as well. And I don't think there's as much of a focus on the cost of making or receiving a payment itself as there is on the actual transaction costs that one might incur through the different toll gates where the transaction process is. So hopefully that makes some sense. But as we in the payments industry think of cross-border transactions, again, it's not just reducing the actual direct costs associated with the transaction as we do with our proprietary products, which we could talk about, but it's also the ancillary costs associated with initiating these transactions and reconciling them appropriately. So a big focal point with our customers that make or receive transactions through us, and I think it's something that the finance community should focus a lot more attention on as well.
Could you specifically tell us more about Boost's cross-border payment solution and how it simplifies and streamlines international transactions for corporate buyers?
Sure. So our marketplace is primarily focused on large enterprises making payments to their supplier and vendor base. And their supplier and vendor base ranges from some of the largest organizations in the world to much smaller ones. But if you look at, let's say, US-based companies paying suppliers abroad, we support about 182 countries, and we have two primary forms of payment, both of which are relatively commercial card centric. The first is a straight through commercial card application, and that's where you may have a company that can utilize commercial cards that might have been issued throughout the world, initiating that payment through Boost, and then we would facilitate that commercial card transaction in the local region. Typically, these may be issued on bins in that local region so that we can get the cost of that transaction to the supplier, typically, who's paying for these transactions, as low as it can possibly be. And by utilizing that mechanism, we can reduce costs dramatically for suppliers that are receiving these payments from these commercial card holders. A product that we just recently launched that we're very excited about, that has already seen an incredible uptake through our financial institution customers, is what we call Boost 100XB. XB standing for cross-border, the 100 standing for the concept that you can use a commercial card product for 100% of your accounts payables spend. And what this product is essentially a two-legged transaction where we utilize the commercial card issued in the United States to that corporate customer, and we process that payment in the United States, typically subject to proprietary interchange rates so that we can get the cost of that transaction way, way down. And that last leg across whatever pond we're looking to facilitate that payment to, again, across 182 countries, that is done via an account-to-account transaction, so that the total cost of that transaction is about a third of what it would be if that US-based company were to use their card directly to pay a supplier in one of those 82 regions. So it's a dramatic reduction in the cost. It's fully digitized. it allows us to not only move the money incredibly efficiently and cost effectively, but it also enables us to move the data associated with these transactions in a way that it can be easily ingested by the stakeholders. And many of these transactions could be in the tens of millions of dollars or higher. They may house hundreds or thousands of invoices, each invoice with hundreds of line item details. So the amount of complexity within these transactions is significant, so the reporting is absolutely paramount. And by digitizing the transaction, we not only reduce the cost of the transaction, but we also enable the data sharing in ways that you just don't have with other payment modalities.
Well, Dean, that was a really insightful perspective. Thank you for shedding light on the crucial topic and for enlightening our audience with the key benefits of your cross-border payment solution. Next up, let's delve into the second story, which focuses on the dramatic rise of account-to-account or A2A payments. The volume of global transactions via A2A payments will rise from 60 billion in 2024 to 186 billion by 2029, an increase of 209% according to a study from Juniper Research. A2A payments, which are bank-to-bank transfers that do not require intermediaries, have gained global traction in recent years as instant payment methods have become commonplace. A2A has gained an advantage over other payment methods with instant settlements and cheaper transaction fees than cards, increasing its desirability to merchants. The study found that open banking developments have enabled the proliferation of A2A solutions. Variable recurring payments or VRPs, an A2A specific solution in which customers connect authorized payment providers to their bank account, facilitate agreed recurring payments on the customer's behalf within set limits. Consequently, businesses and banks have grown interested in VRPs due to the increased flexibility and transparency compared to direct debit. Dean, do you think businesses across various sectors will embrace A2A payments, particularly those companies with extensive supply chains and organizations engaging in cross-border trade?
I think certain segments of the market have already embraced it and will continue to, where others, A2A will be a component, perhaps, of other types of composite transactions. As an example, I mentioned earlier, the way in which we use A2A payments is one of the components of a broader payment modality. So whereas we may have multiple faceted transactions, perhaps part utilizing a commercial card product, part using an account-to-account transfer, as it relates to enterprises, especially those scenarios where buyers are looking for credit instruments to extend their working capital. Again, keep in mind, A2A, once that button is hit to move the money, the funds essentially leave the coffers of the payer, right? And while that is certainly prevalent in small business, gig economy, SMBs, when you get to larger enterprise where there are payment terms typically associated with contractual relationships between buyers and suppliers, certainly the real-time payment component associated with account-to-account becomes a little less important. It's less important because if a payment needs to be made on the 30th day of a payment cycle, whether that payment is initiated on day 30 or it's initiated on day 28 or 29 with the payment being made by the 30th, it's kind of irrelevant to the payee. But A2A, there's nothing new about it, frankly. The RTP component of it is new, right? The lack of delay. But account-to-account transactions via ACH, wire, and other mechanisms have been going on and represent, certainly as it relates to business-to-business transactions, it's been the lion's share of most transactions. I think where it's getting very interesting is where, again, where we're able to utilize account-to-account transfers at the enterprise level of B2B transaction as a component in a more complicated transaction, right? Where we're introducing credit to the buyer, yet for certainly movement cross-border in many areas, domestically, domestic US and domestic international, it's a very powerful instrument that can be used. So while on one hand, it's really nothing new, arguably, but for consumer arena, where you have new instruments that are available to just move money instantly without that intermediary. On the B2B front, we're not seeing it at the enterprise level as being, kind of this tectonic shift.
Wise words and what a thoughtful analysis, Dean. Your explanation reinforces the relevance of A2A payments to the broader consumer landscape or B2C landscape. Now let's turn our attention to the third story, which is about 4 ways to strategically manage cash flow. Successful business operations depend on efficient cash flow management. Indeed, it serves as the lifeline of any organization, particularly in the realm of financial operations. By carefully managing the balance between cash inflows and outflows, businesses can protect their financial health, make strategic decisions, and navigate the complex terrain of financial challenges with confidence and clarity. This involves forecasting future cash requirements and ensuring that there are adequate funds to fulfill these needs while preserving financial stability and steering clear of potential pitfalls like bankruptcy or loan defaults. In a recent survey conducted among finance leaders in North America, nearly half of respondents, or 43%, cited one of the top concerns in the current economic environment is improving their ability to manage cash flow as well as gaining better visibility into their current cash position. Dean, given that efficient cash flow management is crucial for business success, can you suggest a few ways for treasury and finance professionals on how they can manage cash flow far more strategically or efficiently?
Sure. So our company, Boost, is commercial card centric. Many of the transactions that we facilitate on behalf of both buyers and suppliers are commercial credit card products. And we typically sit as a bridge joining AP and AR through our various tech-enabled solutions. And the goal is typically to both extend DPO and reduce DSO, right? And that's the win-win. And by sandwiching the grace period from a commercial card product in between the transaction, you can actually accomplish that win-win, where you can push out the buyers, the corporate card holders' time frame by which they need to make an actual payment for whatever good or product has been acquired, yet you can also have the supplier paid much sooner by virtue of that grace period. Much like we see in the consumer arena, where I walk into a store, I buy a shirt, I present my credit card, I walk out with my shirt, but I really haven't paid anything yet, right? I'm going to get a bill from my card issuer in 30 days telling me I have to pay my balance off in 15 days, right? So I'm essentially extended 45 days of credit, right? Much is the same in the commercial card arena, and that's why it is such an attractive credit alternative to other existing products right now. So frankly, the more savvy companies that are looking for ways to expand their DPO while at the same time creating stickiness with their supplier base and getting their suppliers paid as soon as they can are looking to commercial card products, because it does in fact do that. And whereas 10 plus years ago, card products were not necessarily viewed as a viable alternative to other treasury products, other credit instruments, more traditional lines of credit, et cetera, what has certainly happened over the last 10 plus years is corporations and institutions are in fact looking to commercial cards for that. First of all, it's an entirely digitized process. When we process these transactions, it's completely a passive experience for the payee. So getting back to our conversation earlier in terms of the cost of making or receiving the payment, you're eliminating a lot of the manual processes associated with the movement of money and the closing and posting of transactions on your accounting or ERP platform. So it's a wonderful instrument for both sides of the equation. They both benefit. There are also ancillary benefits. In many cases, the payable, that is the obligation of the cardholder, right, is often treated as off-balance sheet debt. It's not treated the same way in which traditional debt would be treated. And that's really important for certain organizations or institutions that have to live within the confines of debt covenants or other types of covenants, financial covenants. So it's not only a viable, but a very attractive alternative to traditional products. And it does allow you to grow that working capital in between by extending DPO and reducing DSO. And to be clear, when I talk about extending DPO. As it relates to the relationship between the buyer and the supplier, you're actually reducing DPO. You're getting that supplier paid sooner, yet the actual obligation of the buyer is being extended by virtue of that grace period where they have to pay back their financial institution that issued the credit to them via card product. So we're seeing more and more large corporate organizations and institutions embrace commercial card products because of these properties. It allows them to expand their working capital while at the same time reduce DSO or also benefit the working capital of their supplier base, the payees. So it's a win-win.
It's a win-win. Dean, thank you so much for articulating some intriguing strategies for effectively managing cash flow. Let's shift the discussion from cash flow to the fourth news story, which is about combating payments fraud. The rapid evolution of technology has propelled payments to the forefront of corporate finance and treasury. However, this growth in payments has also led to a marked increase in both existing and emerging forms of payment fraud, posing a critical concern for finance chiefs, treasurers, and their teams. As payments fraud becomes more sophisticated, intricate, deceptive, pervasive, and costly, it is imperative for business leaders, CFOs, and treasury teams to stay vigilant and well informed. Dean, you may have reviewed the CTM file article, Combating Payments Fraud, Key Insights Every Treasurer and CFO Must Know. Could you suggest some measures that treasurers and payments executives can implement to confront payments fraud threats and protect their organizations from financial and reputational damage?
Of course. So I think first of all, as it certainly relates directly to payments, but frankly, as it relates to just a broader policy towards combating fraud, cybersecurity issues broadly, make sure that either your internal IT team or outsourced partners are reducing your attack surface, right? That's number one. And both in terms of infrastructurally as well as in an ongoing maintenance and monitoring process. So I think that's kind of table stakes these days for most organizations. And I think those organizations who don't allocate appropriate resources to that functionality and protection do so at their own peril, right? As it relates to payments, as part of the reduction of your attack surface, one key element is to get information out of your system that is attractive to the bad guys, right? So one of the benefits of commercial card products, again, and I hope I don't sound like too much of a broken record, is that when these transactions are processed through a straight-through processed platform like Boost's, neither the buyer nor the supplier are required to hold any of the financial depository data. So often fraud takes place when you have, let's say, a buyer that houses all of the depository information, the bank information for their suppliers and vendors, because they'll initiate wires or ACH transactions or other account-to-account transactions. To the extent they can migrate those transactions over to a commercial card product, it completely eliminates the need for that buyer, that corporate or institutional entity, to have to house any of that depository information of their vendor base or their suppliers. So you've completely eliminated perhaps the most attractive target that would otherwise be sitting within that corporate entity for would-be thieves. Similarly, on the supplier side, right, when you initiate these commercial card transactions through a straight-through processed environment, you eliminate the access to sensitive card data by the payee. So whereas traditional card transactions might require both a buyer or a supplier to house, utilize, store sensitive card data, in a straight-through process environment, you completely eliminate that. Neither the buyer nor the supplier has access to that card data. Again, you've eliminated a very important and attractive target for those would-be criminals, right, that want to go after that data. So by instituting a digital payment process, specifically commercial cards, you're removing the attractive targets from both the buyer and the supplier that criminals would want to go after to implement some type of fraudulent transaction. So that's certainly one way that we do recommend for our customers and partners all the time. And it is proven to show that commercial card products, cards generally, when processed in a straight-through process environment, are certainly among, if not the lowest fraud-related transactions and payments. It's a very safe way to both initiate payments as well as receive them.
Dean, you made some great points, and I couldn't agree more. Finally, what is your choice for the biggest or most important story of the past week or this week, and why?
Well, we're sitting here the day after Election Day, so obviously big news there. And we could, probably have a whole separate podcast, as I'm sure you will, on the implications of that. But I think that aside, the big news, certainly as it relates to our world, is the downward movement of interchange rates. The recent reduction of 50 bips, the anticipated further reduction perhaps over the next couple of days of another 25 bips. How that impacts the credit card arena is profound, right? So what we saw as interest rates rose, the spreads that issuers of cards, extenders of credit, they were squeezed a bit in terms of their spread, right, as their cost of capital rose. And as we started to see rates drop, or even the anticipation of rates drop, we saw that reverse. So while rates were going up, we saw some of our financial institution partners who issue cards tighten up on some of the credit that they were extending or harden some of the terms around their deals. We've seen that it's really now in reversal mode, and we expect that to reverse more and more and open up. So the impact of that is you're going to see, we believe, an expansion of credit to these corporate entities, kind of going back to pre-interest rate spike levels. And you're going to start to see the further appeal of commercial card products, both for the financial institutions that issue them, as well as the customers that are utilizing them, because it's going to expand their access to credit, and it's going to create a bigger spread for the financial institutions that are issuing the cards.
Well, Dean, as we wrap up this podcast episode, I'd like to extend a heartfelt thank you to you for sharing your thought-provoking viewpoints.
Thank you so much, Push. It's my pleasure.
It's been an absolute pleasure, and thank you so much. Your valuable perspectives have truly enriched today's discussion. We would also like to express our deep gratitude to our CTM File audience for joining us on this edition of the Open Treasury podcast. Please subscribe and look in the show notes for the article links. Thank you and have a wonderful week. This podcast is provided for information purposes only, and statements made by CTM File or guests on this podcast are not intended as legal, business, or consulting advice. For more information, visit ctmfile.com.